Hey traders, this is an overview of the rules and the mantras that we follow or try to follow in our live trading room. And I wanted to go over them in great detail here, in this video, because we go through these twice a day. Every single day in our live trading room, we go over these. And yet, as the old saying goes, you never know who is swimming naked until the tide goes out. And conversely, with trading, you never know who's breaking the rules. You never know who is not following good trading etiquette until you have a losing trade. Because if all your trades are making money, all of your misgivings, all of your shortcuts that you're taking kind of get glossed over, right? And we had someone in our trading room the other day, I think very wisely put it, that you don't learn from your winning trades. You learn from your losing trades, because they are the trades that expose your weakness. And so I did want to go over these today because this past Friday we had a loss on our 0 DTE trade on one of them. We had two of them. One of them was a profit, one of them was a loss. We don't have them very often. It doesn't happen too often that we will have a loss on a 0 DT, but we did on Friday. And it stirs up a hornet's nest, and it creates all kinds of things that bubble to the surface as we start to see the weaknesses in our approaches to trading. So even though we go over these, and I touched on some of these with some of our members in our trade room, they said, you should really talk about these. I said, we talk about them twice a day. You're just not listening. So let's go through our rules. And I will tell you this. These rules and these mantras are not academic. They have been honed and they have been learned over decades and decades of blood, sweat, and tears. Most of these rules, most of these mantras are proven to be worthwhile through actual dollar losses. Unfortunately, that's how a lot of us learn. And so, again, I'm a man, and I'm kind of like most of my men friends. I believe that growing with my kids when they were growing up, I took longer than I should have putting all of their Christmas toys or birthday toys together because, of course, as a man, I'm not going to follow the directions. I don't need those. Anything that I do, any product that I install, any work that I do on my cars, it always seems to take longer than it should because, of course, I just jump in without following the directions or reading the directions before I actually get started. So I get it. I understand it. I'm no different. As a trader, I'm no different than anybody else. I break rules all the time, but I understand why I lose money when it happens. And I think that's the critical thing, is that it's easy to put blame on the market. It's easy to put blame on the trade. It's easy to put blame on the strategy. It's easy to put blame on the person that gave you the idea. But ultimately, there are key reasons why we succeed, and there are key reasons why we fail. So I wanted to get into this with you, and I thought probably the easiest way to do this was to just pull up the rules that we go through every single solitary day in our trading room. These seem to be, after our loss on Friday, they seem to have been a surprise to some of our members in the trading room, but we actually go through these every single day. So let me go through them with you as well. And I think they all have value. I think there's wisdom in all of these. And, there's no guarantees in the market. There's no promises that can be made in the stock market. But there is a promise that I'll make you that I absolutely promise you. I absolutely promise you that if you follow these rules, it will help you. It will help you to be a better trader. I absolutely promise you. I know it to be true. So let's go through some of these. So we start off here with one of the government required disclosures. And you go, geez, the government required disclosures. Who cares about those? Blah, blah, blah. There's actually a lot of wisdom in the government required disclosures. And the first one says that trading involves substantial risk and it's not suitable for all investors, and there's no guarantees. Now, here's the point that I take from that. Number one, investing is a very different animal than trading. Yeah, you can trade IBM. Yeah, you can invest in IBM. Just because the underlying is the same does not mean you're doing the same thing. Investing is a complete different animal than trading. So the first place to start, I think, is to really take a hard look at yourself and say, am I a trader, or am I an investor, or am I both? Now, I'm both. I would never be happy with my investing portfolio just by itself. It's too passive in nature. I would never be comfortable. I'd have heart attacks if all of my money were in trading accounts because it's too volatile. But the two together smooth each other out. We have an amazing portfolio allocation program called the AST program, asymmetric trading. It has absolutely just kicked the market's butt every single year that it has been up and running. We absolutely just dominate the market. There's been no down market for us this year. It's just been making money after money after money as the market continues to go lower. It takes 5 minutes a day. That's it. It's a passive program. So step one, figure out if you really want to be a trader versus an investor, or in my case, if you find merit in doing both of those. But they are not the same thing. Understand what trading really is, okay? The other thing that I think is interesting here in this government disclosure, not a licensed financial planner, advisor, or investment broker. I'm not licensed to give investment advice. And I will tell you that my belief is 99.9% of these people on the internet, on social media, that are giving you trading tips are not licensed either, okay? So just understand that, most of the people that you are probably taking trading tips from, they're not fiduciaries. They're not licensed. If they are licensed, they may not be licensed in your state. They most emphatically have probably not sat down with you and gone through your risk profile and figured out what is the right product mix for you. That's all left to you. So keep in mind that no one online should be feeding you trades. Nobody should ever be telling you what to do. They can give you ideas, they can show you what they're doing, but it's not a tip service, guys. It's not something where we're saying, hey, give us your cell phone number, we'll text you out a trade every day. Just follow what we tell you to do. It's not how it should work, okay? In addition to all of that, that's the government disclosures. Here's some of the other things that we talk about. Number one is position sizing. We hammer this all day long, and yet it is the number one rule that continually, consistently, every single day, without fault, gets broken in our trading room. Every day. Position sizing is absolutely the key. Now, position sizing for us means a couple of things. Number one, it means that you shouldn't be putting too much of your overall portfolio in any one position. For us, a general good rule of thumb is 10%. So if you have a $100,000 account, you shouldn't be putting more than 10% into any one strategy. But it goes beyond that. We also then would say, we would go one step further and say, take that 10% that you're going to put into that strategy and divide it into thirds so that you're only starting with 1/3 of that amount and you have dry powder. You can now scale, or dollar cost average, as the case may be, into the position as time goes by. So once again, $100,000 account, you should never put more than $10,000 in any one position. And of that $10,000, you should really only be starting with about $3,000. Okay? That's going to be really, really critical here. We had, again, a 0DTE trade on Friday that didn't work. It wasn't a full loss, but because we did have an adjustment inside of the trade that mitigated the loss a little bit, but it was still a loss. Okay? So if you have, but the key is we did not scale. We did not scale on that trade. So if you had a $100,000 account and you dedicated $10,000 to that particular trade and you started with $3,000, you wouldn't have lost the whole $3,000. You would have lost about $2,700. Okay, that's 2.7% of your overall portfolio. Our 0 DTE strategies have the potential to make 5 to 10% a day. So is a 2.7% loss in your portfolio a bummer? Absolutely. Nobody's excited about it. But it shouldn't be life-changing. You see people that say, I lost 25%, I lost 50%, I lost 60% of my total funds on that one particular trade. That's not an issue with that trade. That's not an issue with what the market did that day. That's not an issue with the strategy being good or bad. That's an issue with position sizing. Okay, so if you are position sized properly, then you're fine, because as step 2 here says, one trade should never make or break you. You should be able to, your position size properly. When you have a trade that can have a max loss, if it's a defined risk trade, it can have a max loss, and you go, well, that's not fun, but it doesn't really matter. It's not that big of a deal in the big scheme of things. Okay, that's when you don't need spreadsheets, you don't need percentages, you don't need to do mathematical calculations, don't need to pull out calculators. If you can have a single trade go max loss against you and go, well, I'm not happy with it, but it doesn't really matter. Now you know your position size properly, okay? The other part of position sizing is diversification. So I took a loss on Friday, just right along the lines with everybody else on that 0 DTE. But I also have 22 plus different strategies that we do inside of the trading room, and 3 different separate trading programs. The AST investing program, which makes money very consistently, and my scalping program, which I made a bunch of money in. And so those helped offset that one bad trade, okay? You need to be able to have one trade go completely against you and still have your net lick, have the net liquidation value of your portfolio go up at the end of the day. Again, that's a good sign that you are position sizing properly. This is the number 1 rule that consistently gets broke in our trading room all the time. If people are, I always ask them, they say, that trade went full max loss against me. And I'm like, yeah, well, that's a bummer. What happened with your other 15 trades? And of course, the answer is always the same. Oh, well, I didn't have 15 other trades. I put all my money in this one trade. Guys, no trader is ever going to tell you that is a wise approach to trading. We certainly don't believe that. Okay. If you're doing that, if you're breaking position sizing rules, if you're not diversifying your holdings where you have multiple non-correlated underlyings trading simultaneously, you're basically breaking everything that we preach. You're going against everything that we talk about as a good, prudent approach to trading. So again, you're going to break this rule at your own peril. Okay. The next one that we talk about is knowing and understanding your trade, or don't trade the trade. It is amazing to me. I've been doing this almost 40 years now, and it is still amazing to me that people will go to Home Depot and they will make 4 visits. They're looking at buying a $600 appliance, looking at buying a stove or a fridge or something. They'll go there 3 times, and they will read reviews online. And they will go through sentence by sentence the warranty on that. And they will ask their friends and neighbors. And then they will just blindly go take their life savings and throw it in something that they don't understand. It happens all the time. And so one of the big things that we say is know and use and understand your risk graph. Every trade can be loaded into a risk graph, and that risk graph can tell you what is the probability of success, what is the probability of failure of that trade, what is the max profit, what is the max loss. It's amazing to me when people are surprised by the gravity or the amount of a loss on a trade that doesn't work. And I'm always like, well, you knew that beforehand, right? I mean, you loaded it up in a risk graph. It stared you right in the face. Oh, of course they didn't. So everything that you should need to know about a trade to see if it makes sense for you. Where is the profit and loss line? Where can a trade go before it starts to lose you money? What's the probability of success? What's the probability of favor? What is the max profit on it? What's the max loss on it? Where does that start to occur? All of that is contained inside of your risk graph. If you're not loading your trades up in a risk graph, to me, you're trading blind. And that just doesn't make any sense either. Okay, so those are some things that we talk about. I really stress this. There are no guarantees of profits in the marketplace. If somebody's telling you they can guarantee you profits, they're lying. I, again, am not a licensed financial advisor, so I don't think anybody you're probably talking to online is. So, or at least they're not a fiduciary that is licensed to work with you individually. So it's against the law for them to give personalized investment advice. So I always tell our members, listen, I can give you output, but not input. I can certainly show you what I'm doing with my own money. No problem there, but I can't advise you, okay? No earnings claims, no investment recommendations. Boy, if all of that right there doesn't make you feel like, wow, I better take ownership of my own trades, I don't know what will. Because nobody is going to lay out the golden path for you. You have to make sure that you understand what you're doing. So we say this all the time. This is one of our mantras. Own your trades. Don't let your trades own you. By owning your trade, what I mean is that you've used the risk graph. So you understand the trade. You understand what the max risk is. You understand what the max loss is. And when you own your trade, meaning you understand the trade, you now are fully capacitated to manage it on your own. So in many of my cases that I see, when I put a trade on, I'll give you my output. I'll say, okay, here's a trade I'm doing. And I will see members of our trading room say, I love the idea. I love the structure of that trade, but I'm going to change the strike prices. You know, I have a different bias here, maybe a little more bullish, a little more bearish. Or a little more greedy or a little more safe, so I'm going to alter the strike prices. Or in some cases, people will say, I love the setup, but I don't like the and I love the idea of the trade, but I don't like the strategy that you're using. So I'm going to go with that exact same underlying, and I'm going to trade the exact same, bullish or bearish strategy, but I'm going to use a different setup. I'm going to use a different approach. Okay, I love that because you are taking ownership of your trades. Otherwise, the trade is going to own you. You're going to get to the end of the day. You're going to have a loss. And here's the problem. The problem is twofold. Number one is not just that your wallet is lighter, not just that you've lost money. It's that you don't know why. You honestly don't know why. You're just like, well, what happened? Well, what happened was you didn't own your trade. You didn't understand your trade. And so when bad things started to happen, you didn't know what to do. Okay. Now, in addition to those, we have a lot of what we call trading mantras, and I think that's really important. We don't call these rules. We call them mantras. If you understand what a mantra is something that you repeat over and over and over. And look, I get it. We go through these mantras every single day in our trading room, and I think it becomes a little bit like the safety warning on an airplane. Nobody's listening to the flight attendants when they go through that, but it's pretty darn important. And again, as I mentioned some of these mantras to our members in our trading room on Friday after we had a loss, some of them said things like, wow, that's a really good lesson. We should talk about that in the trading room. You should go over that. And of course, you got to just laugh because we go over it not once, but twice. Every single day we go over these twice. I type them out into the chat room and then we go over it in a video format. But sometimes repetition needs to happen more than once or twice, apparently. So let's go through these and talk about some of these things. Again, I absolutely promise you guys, I promise you these will help you become better traders if you adhere to them. Number one, trade to trade well. When I started trading, I was just like everybody else. I had $2,000 in an account. I blew that account up. I put $4,000 in another account. I blew that one up. And so my mentor at the time really talked about this, trade to trade well. You know, he had almost a $400,000 account. I was trading a $4,000 account. And so we'd make a 10% return. And he would, of course, bank $40,000. And I would bank a whopping $40. Same trade, same setup, same strategy, Same result percentage wise, but he had obviously made a lot more money. And he was so excited for me. And he's like, good job. You did great. And I remember thinking, I didn't even make enough to buy us both lunch today. I mean, what do you mean? What am I going to do with $40? And his point was that, listen, if you can learn to trade, not for money, but just to trade to execute your strategies correctly, the money will follow. Just trade to trade well. Don't worry about the money. Yeah, I know it's easier said than done, but just trade to trade well. Just put on good trades. And if it results in a $3 profit, so be it. But just trade to trade well. Be proud of your trades at the end of the day. Win, lose, or draw. Can you be proud of a losing trade? Absolutely. Absolutely you can. Because listen, not every strategy is going to win every time. That's not how the market works. If you're a trader, you have had losses. I know you have. You're going to have more losses. We all have. That's how trading works. That's the nature of trading. The point is that you're trading well enough that, again, you're doing things like position sizing where it doesn't matter. It's not going to hurt you in an overall scenario. So number one, just try to do the right things in the right way at the right time and let the money fall where it may. Okay. Number two, mantra, no green to red policy. So I always like to think of the idea that you are called, you're in a court of law and you're called to the witness stand and you're sworn under oath. And the attorney that is questioning you says things like, well, so tell me, Mr. Trader or Mrs. Trader, about this trade. It looks like you started off the day. You put in some really good research. You put in some good efforts. You built this trade. Yep, that's right. And it looks like it started to make money and it went up and you were in the green and you were profitable. Yep, that's right. And then as the day went on, you slowly started to give some of those profits back. It started to turn down and you started to lose some of those profits. Yep, that's correct. And you just sat by and watched that happen. And then the trade went from green to red. And now you're in the red. And ultimately, at the end of the day, you lost money. Yep, that's correct. That's what I did. Would you be able to defend your actions in a court of law, right? We have a lot of trades that have crazy good success rates. I'm thinking of our IWM Credit Strangle right now, which we've had a tremendous success. Well, tremendous success. I mean, we've never had a losing trade in it. That sounds great, right? You know what? A lot of those winning trades were $3, $4, $5 profit. They weren't the profits weren't too much to write home about. But you know what? We have this no green to red policy, which just simply says, look, it's so hard to trade successfully. There's so much work and effort that goes into building a trade. And it's so difficult to get a trade into the profit zone. For heaven's sake, don't lose that. Don't let it slip away. So no matter what a trade's doing, no matter what you think, no matter how you think things are maybe going to change, if we're in a trade that is in the green, that is profitable, and it starts to give that back, we just cut the trade. Just cut the trade. Profits are profits. I don't care if it's $1 million or $1. Don't let a green trade turn to red. Okay. That one rule right there has saved us on so many zero DTE trades. I cannot tell you how many zero DTE trades we have booked profits on at 30%, 40%, 50% capture rates. And everybody says, wait, geez, why are we taking a 30% capture rate on this trade? It looks fine. And then, of course, had in retrospect, as if we would have held it, by the end of the day, it would have turned into red. So don't let that happen. Number 3, uncorrelated methods with uncorrelated markets. So we are huge on this in our AST investing program. There is a reason why not only are we beating the pants off the market's return this year and last year, but that we are doing it at less than 50% risk. The reason that our account is 50% or less risky than the stock market, less volatile as measured by standard deviation, is because we use uncorrelated methods in uncorrelated markets. We're trading all kinds of things. We're trading lithium, and we're trading coal, and we're trading natural gas, and we're trading oil and silver and copper and all kinds of bonds. We're trading all kinds of things that are not correlated to equities. We like to say that they're in the market, but not of the market. We trade all kinds of strategies. We trade all kinds of underlines inside of our live trading room that might be quoted in the stock market, but they don't move with the stock market. So once again, when I talk to somebody who has a massive loss, I say, wow, okay, well, number one, what was your position sizing? And number two, yeah, it's kind of a bummer that that trade didn't work out. Tell me about your other 15 trades. And of course, they rarely have them. And if they do have them, they're all correlated, right? There's a difference between asset allocation and diversification. Diversification just means you have your money spread around. If you have your money in 20 stocks and the Dow drops by 900 points in a day, guess what? All 20 of your positions are going to probably lose money, right? That's not asset allocation. That's diversification. That just means you've spread your money around. So we are in very uncorrelated trades in uncorrelated markets. Every single day in our trading room, we are in a situation where the Dow Jones Industrial Average could shoot up by 1,000 or drop by 1,000. And we would have something that would be going up in value. We don't know what it is because we don't know what the market's going to do on a day in and day out basis. But we always have something that is non-correlated. So that's important. Trade like a professional. Next one, own the trade so the trade doesn't own you. We've talked about that one. If you're not using a risk raft, if you do not we have people ask questions in the trading room and I'm like, you know what? I need to refund your subscription because you're not in the right place. You're not taking this seriously enough. You're asking questions like, when does this trade expire? What is the max loss in this trade? How do I adjust this from this to this? You're asking questions like you are in a car driving down the road at 90 miles an hour and you look over at me and say, hey, by the way, where are the brakes and how do they work? That's what you're doing. So you've got to feel comfortable with look, guys, every day there's an opportunity in the marketplace. You don't need to jump on a trade today if you don't fully understand it. Tomorrow will come. There will be another opportunity. Spend your time, especially if you're in a trading room like ours, where you have the ability to openly communicate with hundreds of other traders on the exact same strategy. Learn that trade first. Figure out how to use your risk raft, and then you can go trade it. Okay? We have a mantra called hoping for the best and expecting the worst. My son now, 18, he's 18, going to college now, but when he was 17 and home, we were doing a lot of trading in his account. He ran a $3,000 account up to 12, 13 grand. And then he spent it all on a car. But so he's not doing a lot of trading right now. But when he was trading, he loved to trade the 0 DTEs or 1 DTEs on the NDX. And so we'd be able to trade. And he'd put $4 grand into this trade, and it had the potential to make maybe $400, $500. And of course, as a 17-year-old kid, he was just thrilled. I mean, he's just like, oh my gosh, that's so much money. That was almost as much money as he was earning in an entire month working part-time, right? So he's very excited. And I would always say, yep, that's great. If that works, you're going to make almost $500 today. But what happens if it doesn't? And of course, his answer is like a lot of people's answers. Well, I don't know. I don't know. What would happen? Okay, well, let's pull it up in a risk raft. Let's take a look at it. Looks like that $4,500 trade that you're going to put on could potentially lose $3,800. Are you okay with that? And of course, he would say, no, I'm not okay with that. Great. Then what are we going to do to prevent that from happening? Right? Always hope for the best. Build your trade. Immediately look at what the max profit potential could be, and then forget it. And shift all of your focus to expecting the worst. What would be the worst case scenario in this trade? What would it be? And then A, is it acceptable, right? Is it a situation where you're properly position sized and you've only got 3% of your overall portfolio in that one position? And if you lost all of it, you would be down 3% on the day, but you'd have other trades working that maybe made 1.5% that day. And so your overall portfolio is only down 1.5% on the day, and it's a minor fluctuation and a teeny tiny inconvenience. Or did you put your entire life savings in that trade and now you're going to be down 40 to 60% of your entire portfolio and basically done as a trader, right? So hope for the best, that's fine, but always go into a trade expecting the worst, and then you'll be prepared when things do go bad. You won't be shocked. You won't be, locked into a position of being frozen and saying, oh my gosh, what do I do? What do I do? What do I do? You've already worked through it. You've already worked through all of the worst case scenarios. The next one is respond, don't predict. There's such an enticement to follow people on Twitter, buy software programs, pay money to trainings and mentors, because there's got to be a holy grail out there, right? There's got to be something that I'm just missing that will allow me to predict what the market is going to do. Every single day, I battle people inside of our trading room. They're usually newer traders, and it usually goes something like, hey, I found this indicator, I found this histogram, I found that, if you use it like this and you use this time frame, it has a 99% accuracy, it can predict where the market's going to go. And you just have to say, that's BS, right? That's wrong. No, I've seen the back tests. And I said, all you got to do is, the market fluctuates. The market moves up and down by about 1 to 3% a day. If you really could capture 1% a day, 1% a day profit, and you could compound that, and you started with $10,000, in 2.5 years, you would have several $billion. So first of all, if you really think what you're doing is correct, show me where your billions of dollars are, right? Guys, listen, stop trying to predict what the market's going to do. Just respond. We try really hard to find good, solid support and resistance lines, and we trade off of those. We trade level to level. We don't care if the market's going up. We don't care if it's going down. We don't care if it's going nowhere. It's irrelevant to us what the market does because we're not trying to predict it. We're just responding to what it gives us, okay? Stop trying to predict the market. It's a wasted effort. Focus on the process and not the outcome. Again, it is a little bit like trading to trade well. Focusing on the process, making sure that you are following the steps and not focusing on the income. I shared this in our trading room many times. I had a wonderful trade set up. This is years ago now, but it still serves a good illustrative purpose. I had a wonderful trade set up, and I did everything right. I built the trade with the right probabilities and the right deltas and the right strike prices on the right underlying in the right market situation. But the trade, as it was constituted, would generate about a $900 profit for me if I left it as is. Well, I wanted to purchase a drone, and the drone was $1,250. And I thought, what would be great is if this trade could pay for the drone. And so I started mucking about. I started altering strike prices. I started over position sizing. I started breaking our rules so that the trade could yield $1,250 instead of $900. Guess what? Trade ended up losing about $3,000. And it was all because of the alterations that I made. So again, guys, I know it's hard. I get it. I know it's hard to not focus on the outcome, to not focus on how much money a trade could potentially make you. But don't. Just focus on the process of building solid trades. And at the end of the day, I promise you, if you do a good job of that, the money will come. Okay? The other one that's very important here is the only variable you can control is risk. Man, there's so many risks in the stock market, aren't there? And I remember when Trump was president, and you just every day you would just cross your fingers that there wasn't going to be another tweet that came out, because every single one of his tweets seemed to move the market. And of course, how do you predict that? And to a certain extent, every day is like that in the market, right? You just never know when something is going to happen that's going to move the market around, that's completely unforeseen, and it's completely out of our control. All of these variables that affect the result of a trade, 99% of them are not within our control or reach. But you know what is? Risk. So I'm going to say something just maybe controversial here, but think about it for a second. There is no risk in the stock market. There is absolutely no risk in the stock market. There is no risk in any of the strategies that we employ. Now, before you tune out, let me finish. Okay. The risk comes from you and I as traders and how we choose to enter those situations. Okay. In our AST program, again, our investing program, it's done so well against the market, but it's done it at so much less risk. You know why? I'm going to give you some really deep, insightful information here for trading. You know why we don't have as much risk in the AST program as the stock market does? Because we don't allow it. We just don't allow it. We take losses inside of the AST program all the time. Because as Mark Minervini likes to say, every single massive loss starts with a tiny loss. And if you're cutting those losses when they're tiny, you never can get to a massive loss. We're never going to get to a massive loss in AST because we won't allow it. Okay? So again, just focus on the one thing that you can control, and that is risk. No one is going to determine what you lose in no one or no thing will determine what you lose in a trade but you. It's not the market. The market dumped. The market dumped on me today. Oh, this strategy, day trading. Day trading's risky. It's not the strategy. It's not the market. It's you. You and I, as individual traders, we control the risk of a trade. We get to decide when we exit a trade. Okay? That's huge. If you can really assimilate that into your trading patterns, that's huge. Last one here is if you can't define your edge, you don't have one. Just because you have an edge in trading doesn't mean you're going to make money, but it certainly opens the possibilities to a greater chance, doesn't it? So, I've done a bunch of videos recently. One of them was on our IWM trade and using risk graphs and understanding how those work. And I demonstrated that, when you buy something, you might do the best research. You might think, oh, Tesla is the greatest stock in the world. It's fine. You might think Tesla is the most overvalued stock in the world. That's fine too. But however you approach that, if you buy Tesla, statistically, you have a 50-50 shot of being right. If you short Tesla, statistically, you have a 50-50 shot of being right. Think about that for a second. You're entering a trade that is giving you a 50% shot at making money. Do you really think that's the edge that you need to be successful? So we build trades all the time that have definable edges, definable advantages. Again, it doesn't guarantee you anything, right? Doesn't mean you're going to make money. But it's certainly better than not having a trade with an edge. So if you can't define your edge, if you can't get on that witness stand, be sworn under oath, and have the attorney that's questioning you say, why did you think this was a good trade? What did you see in this trade that made you feel like you had an advantage over other traders? Man, if you can't define that edge, then it was probably a trade that you shouldn't have taken, right? Okay, so those are some of the things that we think about. Again, we call them mantras, not rules, because we repeat them over and over again every day. We also talk about following protocol. That's just a big overview. So one of my friends has a spouse that is a doctor, and she was talking about famous people that had passed away on the operating table, and I thought it was an interesting metaphor for trading. All of the doctor, and these are people that died on the operating table because of errors that were performed. But you know what? None of the doctors that killed them, and I hate to be blunt about it, but the doctors did kill them. None of the doctors that killed these individuals were incompetent. I think that's important. If you're losing money in the market, it's not that you don't have the ability to be a successful trader. It's not that you're incompetent. It's that you're probably not following protocol. Those doctors broke rules. They didn't follow protocol, right? So if doctors have a Hippocratic oath, we have a Hippocratic oath as traders, and that is to do no harm to your account. Let's first of all focus on not losing our butts. And then let's talk about getting rich, right? But let's put it in that order. And then last but not least, discipline dictates action. Be disciplined in your trading. Every single solitary time I have ever lost money in a trade, it's because of a lack of discipline. I've come in to one of our rules and I've broken it. Okay, so hopefully those help you. I know this is a long video. Hopefully you've watched to the end, but I promise you, if you do adhere to these, you will be a more successful trader. And whether you're part of our trading room or not, that's what we want for everybody. If you're not a part of our trading room, I'll drop some links below. And you can come check out our trading room for a free trial. But man, whether you're part of our group or not, folks, trade to trade well. Do the right things at the right time in the right way, and you'll have better success. I wish you all well. Take care.